Good morning, sir. Myself, Kaustav Kashyap, and today I will be presenting on the role of microfinance in rural development, typically the case studies as it was assigned to me. As we look at this landscape of rural India, we see immense potential often held back by a lack of financial access. Today, we'll explore how microfinance acts as a bridge between the poorest segments of the society and the formal economy. Impact area and observed outcomes. When we talk about impact of microfinance, we look at four key pillars. The first one being income, which ensures stable and predictable cash flows for households. The second one being employment, which fosters self-employment and small entrepreneurial ventures. The third one being women empowerment, it enhances their decision-making power and social agency. And the fourth one being credit reforms. It acts as an institutional substitute for high-cost, often exploitative, informal money lenders. Now, if we talk about the socio-economic impact, then the core objective here is simple yet profound: to provide a formal, sustainable alternative to money lenders while ensuring the poorest have capital for growth. This directly addresses systematic flaws in traditional rural credit. Key features include timely loans, reducing wait times for seasonal needs, flexible repayment, aligning with rural income cycles, no collateral, removing barriers for those with no physical assets, small ticket sizes, microloans designed for daily business needs. Now, if we talk about our first case study, that is SHG bank linkage model. One of the most successful models is the self-help group or SHG bank linkage program, which was launched by NABARD in 1992. This model integrates informal groups into the formal banking system. Instead of physical collateral, it uses social collateral, where social bonding and peer pressure enforce repayment discipline. Typically, 10 to 20 women save for 6 to 12 months before the bank provides credit. Now, coming to our second case study, that's MFIs, speed and scale. While SHGs are community-based microfinance institutions, or MFI bridge the gap for larger credit needs. They bring faster disbursement through tech-enabled operations, professional management with standardized products, sustainability by accessing capital markets for funding. And if we talk about bank-led microfinance challenges, why can't traditional banks just do this directly? They face three major hurdles. The first one being transaction cost. High overheads make small loans expensive to manage. Limited staff. Banks often lack the ground presence for last mile monitoring. An information gap. It is difficult to assess risk without a deep community ties. Now, if we talk about strategic intermediation and NGO evolution, this is why banks prefer the partnership model. Banks provide capital stability, while MFIs or NGOs handle high-touch community engagement. Interestingly, many foundational NGOs eventually convert into MFIs. They do this to access more capital and professionalize their operations to reach thousands of villages. Uh, the next slide discusses on trust before credit. Organizations like Seva and BRAC prove that trust precedes transactions. By integrating finance with health and education, they build long-standing relationships and that allow them to reach the absolute poorest households. Now, if we talk about the foundational reasons why NGOs convert into microfinance, is the first reason being capital access, stepping into capital markets and bank funding for sustainability. And second one being scalability, professionalizing operations to reach thousands of villages effectively. Now, if we talk about the outcomes, What does success look like? A 5-year study showed transformative results. The first one being production, local dairy, poultry, and retail activities surged. Women's participation rose significantly, and independence, reliance on exploitative moneylenders declined sharply. However, microfinance is not without risk, I would say. We must guard against over-indebtedness. Sorry, we must guard against over-indebtedness, climatic risk that affects repayments, and low financial literacy. The solution is to combine credit with capacity building. Finance is just a tool. Skill development is what creates a path for rural prosperity. So, thank you for giving me your time. This was it from my side, and I would like to thank for giving me this opportunity to present in front of you. Thank you.